Welcome back to my YouTube channel, if you can even call it that, since I have very rarely put out regular content on this platform, and I apologize. If you're a subscriber, you know I'm typically here for a good time, not a long time. So if you want me to be here for a longer time and try and put stuff out more consistently, please like this video. It will give me a dopamine rush, and that will increase the likelihood of me making more content, which is... I do like doing this. I just, YouTube has been a difficult platform for me. As you can see behind me, I've built a real life green screen. If you follow me on any other platforms, you know that I like to do a lot of green screen videos where I basically just put charts behind my head and talk about them. And so I've tried to make it very easy for myself to create content on YouTube, and hopefully this helps. Also, really the primary reason why I made this green screen setup is to make Jordon Scrinko jealous, because he has more followers than me on YouTube and a couple of other platforms. And so if you also want to make Jordon Scrinko jealous, please subscribe to this video so that I can beat him in the race to reach some arbitrary number of followers that will be established in the future once I'm closer to his subscriber count. So today I'm basically just going to go through CMHC's most recent mortgage industry report. A couple of charts stood out to me. I'm going to try and talk about this for about 2 to 4 minutes. Just actually probably end up being longer than that, let's be real. Talk a little bit about the charts that stood out to me and some of the changes that we're seeing in the mortgage space, and what I expect and what it means for owners and purchasers of real estate in Canada. So the first page of the report says a slowdown in mortgage activity was fueled by fewer home sales, which we know the real estate industry is down substantially in volume, well below the 10-year average. But despite this, mortgage debt continued to grow. So not an exceptionally good picture there. This first chart here shows that borrowers have started to prefer fixed mortgage rates with terms of between 3 to 5 years. So I might just try and blow this one up and put it above my head here. So you can see the pink line is your variable rates. That's that period of time when variable rates were exceptionally popular. And that, I guess that would have been like when you could get them for basically nothing. And this became a big problem for the static payment variable rate borrowers and a lot of the banks. And then you can see the red line is your 3 years to 5 year term, which you can see climbing. And the dotted line here, you did see a period of time when your 1 to 3 year fixed rates were becoming in favor, and those are becoming less and less popular as sort of people seem to basically start accepting the kind of higher for longer rate environment that we're starting to see in Canada, and not trying to call the central bank's bluff by taking a short rate and hoping that they can refi out of it in that 1 to 3 year term at a better rate. The next chart that really stood out to me was that alternative lenders were starting to increase their market share. So this tells me, so you see this phenomena in the Canadian real estate space where borrowers try and go up the value chain of lenders. So, you know, if you're high leverage or you're an investor or speculator, you get, just to get yourself into a property, you take on a higher risk loan. Maybe you take on a private loan, but then your goal is to, after a year, would be to refinance that with maybe move from a private lender to a B lender. And then after 2 years, maybe you're moving from a B lender to an A lender. Nobody really goes into a private or a B expecting to stay there forever. And you're starting to see the opposite thing happen, where people can't really escape. That escape route is kind of gone because underwriting's so tough. A's and B's are contracting credit. And so the mortgage space isn't exceptionally favorable for that kind of step-up model in the quality of mortgages that people are bringing, or sorry, quality of mortgages that people are using, or the cost especially. So they cover pretty substantially the risks and vulnerabilities that they see to the housing and finance system. It's very wordy, so I'm not going to go through all of it, but I would encourage you to read the report. But this is really where it starts to, you know, you can see from my perspective, you can really see that the industry is starting to break. I would say most people would look at this chart and say, well, if you look at the y-axis, then, you know, you can see basically the numbers here are low, right? You've got like 0.35%. This is delinquency rate. So way less than 1% delinquent on almost all mortgage types or mortgage sizes. This is by sizes. But what is fascinating to me is that the biggest mortgages, and typically, so your 600K to 850K, the red line, and the 850K and more, this pink line here, that one really, I mean, you can see it just ramping up substantially here. I'm just gonna blow this up so you can really get an idea for that curve. So you can really see this pink line here ramping up quite substantially, which to me is just evidence that, you know, there's a lot of these groups who were taking on too much leverage to be able to buy a home to keep up with the market are suffering, and these are the loans that are going delinquent. So that your $850K and more mortgages, I mean, really, where are you seeing houses that are worth that much? Probably Vancouver and Toronto early on. And this is back when I was even doing YouTube talking about this stuff. When I was doing market reports, I was mentioning how a lot of those, like the markets that really ran up in price faster, are more credit sensitive. And so as interest rates started to increase, that credit sensitivity really kicked in, and these loans, these markets started to come down as the borrowing power was stripped away from these buyers, and now you can really see the long-term impact of that, where you're starting to see that delinquency rate really creep up on the $850K and more mortgages. They acknowledge that while mortgages in arrears are stabilizing at historically low levels, which I don't necessarily agree with, it's pretty evident that they're climbing. They show arrears of other credit products suggest that an increasing share of Canadians are struggling with their debt payments. So you can see auto loans, especially here, are going up pretty substantially. Credit cards, which is the gray bar after them, but still climbing. And the credit cards does seem to have kind of flatlined in the last 2 quarters. Next up, we want to look at mortgages for the purchases of property and refinances saw significant drops from the first half of last year to this year. So we're just seeing a much slower market, right? People are just really buying and selling less real estate. And that's a pretty consistent theme. I'm going to try and start covering the Canadian Real Estate Association CREA stats on a relatively regular basis. But that shows this as well. You'll see it. You'll see that the volume is well below the long-term average. GTA real estate market just saw the slowest October, I think, since like 2006, 2007 maybe. So things aren't looking exceptionally good. This is just lender risk indicators that they cover. There's one other chart I just want to cover here, which is mortgages in arrears, which is delinquent for 90 days or more. So I've said for a while, if you follow me on Twitter, and I post this chart, I'm just going to pull it up actually. So I post this chart, which is your monthly listings on the Toronto Real Estate Board that include power of sale or mortgage in the seller name. And you can see it's up. It hasn't done a ton this year. Like, you know, it's gone up a little bit this year, but it's up 100% on a year-on-year basis, and it's up 200% on a 4-year basis, or sorry, 400% on a 2-year basis. And so I had always felt like, okay, if we're seeing power of sales go up that much, it's only a matter of time until we see the delinquencies rise accordingly. And that's, like, if you think about it, if you're going from 0.2% delinquent to and you multiply that by 4, you're still at 0.8% delinquent. You're still below that 1% delinquency rate that Canada has never hit. And so it's not like the sky is falling, but it's a meaningful impact, and it's worth looking at. So mortgages in arrears, you can see here. So for credit unions, chartered banks, it's a very, very slight creep up on your A side lenders here. Credit unions actually, I think, are coming down in the last 2 quarters. So chartered banks and credit unions not seeing much increase. So that's these 2 right here, like really low to begin with, and then continuing to be really low. Where it starts to get fun is if you're looking at your other non-bank lenders and your mortgage investment entities, or MIEs. And you can see in these ones that basically they've been climbing since your middle bar here, the I don't know, you call it blue bar, and then you've got a pink, a gray, and a purple bar growing on a relatively consistent clip. And this is something I acknowledge. I'm very careful about pulling stuff with like lender names, etc. But you know, the composition, looking at the composition of those power of sales, that power of sale chart that I just showed you, you can see that, you know, if you look at the past 6 months, there's a lot more institutional private lenders that are taking properties power of sale than there are individual private lenders. An individual private lender would be like mom and pop takes a HELOC out, gives it to some speculator, and then that speculator stops paying the mortgage, and so they take them power of sale. An institutional private, rather than an individual private, that's an individual, 1 person or two person, an institutional private would be like a MIC, a mortgage investment company, mortgage investment entity, MIE. And yeah, so we're starting to see delinquencies climbing. I think like this, from my perspective, I'm just going to wrap it up here because I realize I'm being a little long in the tooth, as is tradition. We are starting to see, from my perspective, like this is what a recession feels like. This is the wheels kind of coming off the Canadian real estate industry. I would pay very close attention to these reports that come out from CMHC. I would pay very close attention to the number of power of sales that we're seeing in the market. I don't necessarily think that there's a blood in the water kind of buying moment yet, but I think that we're really getting close to prices shedding a little bit more, and there being a good investment opportunity, perhaps once in a lifetime investment opportunity, which I've said on this show before, or on this channel before, years ago, that I felt that once we get to the recession and we get to that real estate counter cycle taking place like we saw in the 90s, which I honestly think that price wise it'll look very similar. And maybe I'll just wrap up with that. In the 90s, 89 prices dropped like 20%. In 1990, they actually came up a little bit, and then they dropped again, which we just saw happen in the GTA. So we saw 2022, we saw a huge drop in house prices. We just saw a little bit of a bull trap at the beginning of 2023. Then we saw house prices basically grind down from May until now. They've kind of stabilized a little bit with the fall market. But in the 90s, after that little bit of like the blow off and then the bull trap and then the fall that happened after the bull trap, it really was like a long-term grind down. It took years for house prices to reach their bottom. And this is what I expect to happen here. I think we'll have a long bottom that will present a lot of opportunity for people to buy and sell safely. And ideally, as rates start to come down a little bit and prices are down, there will really be a good opportunity for people to enter the market on an affordable basis. So that's my 2 cents. That's what I think. That's what I think the data is telling us. The opportunity is going to arise. Pay close attention. Be nice to each other. Especially, I think a lot of people are really hurting financially in this country. And that's all I got for you today. Oh, and also subscribe to my channel to help me beat Jordon Scrinko to the future arbitrary number of YouTube viewers. Thanks.